afternoon, depending on where you are. Welcome, everyone. Thank you for joining us today. My name is Matt Bradley from the Marketing Department at Foley & Lardner. I'm pleased to welcome you all here to our program, The Impact of Tax Reform on Private Equity Funds. We have some great presentations for you planned from our speakers. Before I hand it over to them, though, I would like to go over just a little bit of housekeeping, if I could. The questions, there is a widget in the environment that you're in so you can ask questions during the course of the program. If we have time, of course, we want to get to those, but please feel free during the course of the program to put those questions in if you have any, and we'll, again, deal with them at the end of the program. The PowerPoint presentation that you guys are going to be seeing will be available on Foley.com. It's also available inside of the resource right now as a PDF in the resource list widget, which you should be seeing in your environment. We've also included in there a CLE affirmation form for those of you who are in Kansas, New York, or New Jersey or seeking credit in those states. You'll need to complete that affirmation form, so please take advantage of downloading it or printing it while we're in the progress of the event. To obtain CLE credit, I'm going to read aloud at a point in this presentation a 5-digit code. It will be available to you on the screen, so you just have to type that code in. And we'll give ourselves time to get that done. But note that certificates for this program will be distributed about 8 weeks after the web conference. If you have any questions or any issues, you can email me directly at mbradley@foley.com, and we'll take care of those as they come in. With that and the housekeeping in order, I'm going to turn it over to our presenters today, Raj Tandon and Ashley May, with my thanks. And the floor is yours, guys. Thank you.
Well, great. Thanks, everyone, for joining. I'm Ashley May, joined by Raj Tandon. As a brief overview, we'll be covering rate-related provisions, which will quickly discuss the changes in the different tax rates and changes to carried interest. We'll also be covering certain deductions, the pass-through income deduction, interest deductibility, miscellaneous itemized deductions. We'll also be covering international provisions, such as hybrid transactions and what has been given the names of GILTI, BEAT, and FDII, and then a few other odds and ends that we'll be covering towards the end of the presentation. Just some quick background. So what has been commonly referred to as the Tax Cuts and Jobs Act was signed into law this past December 22nd, and herein we'll be referring to it as the Tax Act. Most provisions took effect as of December 31st, 2017, but we will know when there are any differences. And with that, I'm going to pass it off to Raj to handle the rate-related provisions.
Thanks, Ashley. So just turning now to that slide here, you can see on the left side of the slide the old tax rates. You'll see that the highest tax rate for individuals was 39.6%, and for corporations was 35%. You'll see that on the right side, the highest effective or stated tax rate is 37% for individuals, but the corporate tax rate has had a drastic reduction to 21%. Capital gains rates stays the same, and the so-called Obamacare tax, or the 3.8% tax on net investment income, is still in effect as well. So most people are actually going to continue to pay a 23.8% federal income tax on capital gains. So something to keep in mind. Also, these changes in individual rates are somewhat misleading because, as probably many of you know, there is now a very steep limitation on the deductibility of state and local taxes. Generally, for tax years beginning after 2017, an individual can only deduct up to $10,000 in any state and local taxes in any year in the aggregate. That includes income taxes, property taxes, and the like. The impact of that has been somewhat mitigated by the fact that there is a much larger standard deduction. So really only people like myself and Ashley in high tax states are going to suffer as a result of this. There's also a lower limitation on new mortgage mortgages taken out after 2018. That's now been limited to $500,000. And as Ashley will talk about, there is also a now total denial of deductions of itemized deductions, or what were known as itemized deductions. They are now non-deductible for several years, and that actually has an impact on what people do with carried interest that we'll talk about. Regarding the corporate tax rate, so the stated rate is 21%, as I just mentioned, but there are new exemptions in the foreign income world that actually reduce that rate substantially, and we now have a new limitation on interest deductibility under new Section 163J, which actually may, for leveraged corporate taxpayers, drive that rate up. So, depending on your circumstance, your rate may be substantially lower or higher than 21%. Moving on to the next slide here. Carried interest. What exactly is a carried interest? Well, a carried interest is essentially the right that a fund manager has, sometimes through the general partner, sometimes through an affiliated entity, to receive pass-through income from the private equity fund, and it's become known as a carried interest. The idea is that if the underlying fund realizes capital gains, that the manager of the fund can get a share of those capital gains simply by being a partner in the fund, directly or indirectly, through, say, the general partner. There's been a lot of talk, I think, going back for 10 years about changing the carried interest sort of loophole and require that carried interest recipients are taxed as ordinary income on their carried interest, and very complex provisions have been proposed to address this. The new law takes a different approach and instead simply, or perhaps complexly, just applies sort of a 3-year holding period to obtain capital gains treatment. And so we'll sort of go through how the new rule applies here. The first point is that you have to have an applicable partnership interest, which we'll talk about on the next slide. And if the asset which is producing the capital gains is held for less than 3 years, it is taxed as short-term capital gain. There may be some benefits to short-term capital gain versus ordinary income, but by and large, short-term capital gain is simply taxed as ordinary income. So there is now obviously this longer holding period that applies to such assets. So going on to the next slide here, we get into some of the weeds of an applicable partnership interest, which is an interest in a partnership which is transferred to a taxpayer in connection with the performance of substantial services in an applicable trade or business. And what is an applicable trade or business? It includes raising or returning capital and investing and disposing of specified assets. And specified assets are essentially investment-type assets, securities, commodities, real estate, cash, options, derivatives. So essentially any kind of sort of investment business conducted through the partnership or investment management is going to cause an applicable partnership interest to be subject to this 3-year rule. So it's hard for me to see an exception. So if you're the manager of a fund and receiving a carried interest, which is essentially an interest disproportionate to the capital that you put into the partnership, you are now subject to a 3-year holding period with respect to that interest. Going on to the next slide here. The 3-year holding period, the actual statute says that there's a 3-year hold with respect to the asset. And so there has been a question of what does with respect to the asset mean? Well, it at least means with respect to the underlying assets of the partnership. So if the partnership producing the capital gain has not held the asset for at least 3 years, the manager's share of that capital gain is going to be classified as short-term capital gain. There has been a question about whether or not the carried interest itself has to be held for 3 years again, because the statute simply says with respect to the asset. But I would say most people, and certainly we would agree, that does mean that it also applies to the carried interest as well. And so regardless of whether you are selling or having your carried interest redeemed or realizing gains passing through the underlying fund, that you're going to want to make sure that there's been a 3-year holding period to produce a now continuing capital gain to the recipient. The statute also has this very weird language. Some people refer to it literally as word salad that says the 3-year holding period requirement applies regardless of a Section 83B election. We really have no idea what that means. Under sort of current IRS guidance, you're treated as a partner regardless of whether you've made an 83B election with respect to a carried interest or profits interest in the partnership. If you haven't made the 83B election and you're not comfortable that you're a partner, well, then you wouldn't be getting capital gains treatment anyway. So it seems pretty clear to us, at least, that whoever drafted the statute really did not understand the interplay between Section 83 and 83B elections and what carried interest produces. And we suspect if there ever is technical corrections that this language will disappear, but it is there currently. The next bullet points out that there is still a 3.8% tax on or Obamacare tax on net investment income, which we would expect to apply in most instances of a carried interest. So, because of this tax, a recipient may actually be worse off receiving a carried interest as opposed to, say, a contingent performance fee from the fund, because the 3.8% tax added to the new 37% tax gets you to a 40.8% tax, whereas if you can structure it sort of as a performance fee and avoid self-employment taxes, then you're not going to suffer that 3.8% Obamacare tax. So, we'll talk about more about that in detail in a second. But like I said, at first glance, it looks like you're actually even worse off if you fall within this, 3-year holding period rule, as paying a higher tax rate than if you simply structured your carry as a fee as opposed to a partnership interest. Now, interestingly, the way the statute was drafted, it created a blanket exemption for corporations, which said that essentially if you held your API through a corporation, then you were not subject to these essentially 3-year holding period rules. And the statute did not distinguish between S corporations and C corporations, and so many people thought that you could avoid this new limitation if you simply moved your carry to a S corporation. And you may have heard that many hedge funds were setting up LLCs in Delaware, and presumably they were going to be making S corp elections for those LLCs, essentially be taxed as corporations, and as S corporations to take the position that this new 3-year holding period would not apply. However, the IRS literally came out with a notice this morning, Notice 2018-18, which said that it interprets the new law as applying to S corporations. So I wonder how people might feel about the S corporation sort of loophole now, considering the IRS's notice. But anyways, there was at least that uncertainty about S corporations until now. So moving a little further into the weeds here, so your typical private equity fund, in our experience, has an intention to hold assets for 3 years or longer. So setting aside issues of, say, add-on acquisitions where you can have a sort of hybrid holding period between long-term and short-term assets, we would expect that your typical private equity fund would not be materially impacted by this rule. However, hedge funds very quickly turn over their assets. I mean, they rarely even, well, I should say, they might hold assets for a year, but they're not going to be holding assets for much longer than a year. So they have really been hammered by this new 3-year rule, hence, the desire to try to find loopholes around it. But, there appears to be some exemptions here or exceptions to the 3-year rule. So, for example, Under Section 1256, which applies to essentially traded derivatives like futures contracts that are traded, there is an automatic 60-40% rule where 60% of the proceeds are, I think, short-term capital gains and 40% are long-term, although I may have that backwards here. So you automatically get a large portion of your assets as long-term capital gain. It doesn't matter if you've held a 1256 contract for literally one day, you get that sort of 60-40 rule. So right now it appears that you continue to get that 60-40 treatment if your asset in the fund is a 1256 contract. Also, qualified dividend income. Qualified dividends are essentially dividends from domestic corporations, C corporations, and certain foreign corporations where there's a treaty with the United States with that foreign company's jurisdiction, that as long as you meet a relatively simple holding period rule, which is, I think, 30 days before and after the ex-dividend date for a common stock dividend, that you receive essentially capital gains treatment on that qualified dividend income. It is taxed at the 20% capital gains tax rate to an individual. And so there doesn't appear to be a 3-year holding period for the underlying asset which produces the qualified dividend income. So I guess some good news there on some of these assets. There's also been questions that arises on multiple tiers of investments where perhaps the private equity fund isn't investing directly in the asset, but it's a co-investor in another fund. I mean, how far down below do you have to go to the 3-year holding period? And quite frankly, we simply just have no answers to questions like that. They're open right now. And so going back to one of the points which I had raised earlier, which is what do you do about this? I would say that, depending on the strategy of your fund, you very well may want to consider amending your fund documents and taking the carry as a performance fee because, again, if you do it right, one would hope you'd avoid the self-employment taxes and you also avoid the Obamacare tax. There's also another, I guess, problem that you have with a carried interest, which is that you have to remember that a carried interest is comprised of actually two items. It is gross income from the underlying fund, and it consists of a share of the partnership fund expenses. And as Ashley will talk about, fund expenses often can be considered miscellaneous itemized deductions, and so they were limited before, and now they're simply non-deductible. So depending, again, on your fund circumstances, because of the avoidance of the Obamacare tax, because of the denial of itemized deductions, that you may very well prefer to take your carry as a fee. And what we've actually done with some clients is have a toggle feature, and we allow them to elect year by year whether to take, on a retroactive basis, whether to characterize their performance amount as a fee or as an allocation of the fund's income. And at least some of the big four we've worked with have been comfortable with that, but we can't say that's always been the case. So I would say before you do something like that, make sure the accountants are on board and won't take a contrary position. One thing you have to worry about with a performance fee is Section 457A. If you have tax-exempt investors or foreign investors in your fund, you have to make sure that your performance fee is compliant with Section 457A. And I would say most people believe that that's very simple to comply with. All you need to provide is that the manager, can resign, and if the manager resigns, that it no longer receives any contingent sort of performance fee or fee after it's resigned. So an easy fix, but something that you ought to take care of. So with that, I'll now turn it over back to Ashley.
Great. Thanks, Raj. So now we'll move into various deductions that have either been added or omitted in the new code. Starting off, we'll address the new Section 199A, and this is where individual taxpayers can deduct up to 20% of their qualified business income, or what we'll be referring to from now on as QBI, that is received from an entity. and this is applicable for tax years 2018 to 2025. But as we'll discuss, this is actually going to have a very limited impact to LPs and GPs and funds. So QBI includes the net amount of domestic income that's generated from a quote-unquote qualified trader business, and we do want to point out that this applies to domestic income as opposed to worldwide income. A qualified trader business means any business other than a specified service trader business, which we'll get into a bit more detail on the following slide. QBI does not include certain investment-related income, which picks up both short and long-term capital gains and dividends. Income attributable to investment management, and this is partially why the QBI deduction won't have a significant impact on funds, because fund management fees probably will not be included in the definition of QBI. QBI also does not include amounts distributed to a partner acting outside his capacity as a partner, guaranteed payments for services rendered to the entity, and payments in the nature of compensation for services. The limitations on this 20% deduction will apply if your taxable income exceeds a quote-unquote threshold amount, which is $315,000 if you're married filing jointly, and if your taxable income is above $100,000 more than this amount, then the deduction is phased out completely. Limitations on this include income from a specified service trader business, which is not included in QBI, and this is another reason that the QBI deduction won't typically apply to funds, because financial services and investing are considered to be specified trades or businesses. The total taxable income is subject to a phase-in range, and it's very complicated, and we could probably hold an hour-long webinar just to explain how the phase-in range actually works, so we won't get into detail here. But the QBI deduction also has a W-2 wage and capital limit, where the amount of the deduction is limited to the lesser of 20% of the QBI or the greater of 50% of either W-2 wages or the sum of 25% of the W-2 wages and 2.5% of the purchase price of qualified property. Interestingly, they didn't include an assets adjusted basis, and it really does appear that they meant 2.5% of the purchase price of qualified property. And also for pass-throughs, the owners will be deemed to have earned their allocable share of all W-2 wages that's paid by, and also their allocable share of the qualified property of the business. So even if the partner only receives a K-1 from the pass-through entity, for QBI purposes, they will be deemed to have W-2 income. So to summarize, except in the case of a real estate fund, it's not likely that a limited partner's income passing through an investment fund will qualify for the pass-through income deduction. And as Raj had briefly touched on, carry income, unless it's attributable to real estate, and management fees will not qualify for this deduction. Moving on to interest deductibility. Before, a business was generally allowed to deduct all interest paid or accrued in the year it was paid, subject to certain exceptions. But now, the deduction for business interest is limited to the sum of business interest income, 30% of adjusted taxable income, which is in quotes because there are certain items which are included in this which may not easily come to mind. And then an obscure concept called floor plan financing interest, which is aimed at car dealerships. Any unused balance can be carried forward indefinitely, and in the pass-through context, this limitation is applied at the partnership level. And it's also worth noting that there's special rules for pass-throughs to prevent double counting by the partners so that you're not actually double dipping twice on the same interest expense. Moving right along. So here we've laid out the certain inclusions for calculating adjusted taxable income, but particularly of note is this last bullet, which says that for taxable years beginning before 2020, any deductions for depreciation, amortization, or depletion are included. There's also an exemption that limitations do not apply for certain corporations, and this includes businesses that don't meet the 25 million gross receipts test and this is based on a 3-year trailing average. There's also an exception for electing real property trades or businesses. The impact of funds on this really depends on the type of funds that it is. It might be time to reconsider leverage blockers, and again, this really just depends on the type of fund and the potential impact. Moving on to the next slide. So as Raj had briefly mentioned in his discussion of carried interest, regarding miscellaneous itemized deductions, before, an individual was allowed to take miscellaneous itemized deductions to the extent that they exceeded 2% of their adjusted gross income. And this included an investor's share of the expenses of a fund and management fees paid by the fund. But now, miscellaneous itemized deductions are disallowed for tax years 2018 to 2025.
So just moving back to a couple points on the interest limitation. I may have gone too far back here. Let me find that slide here. Yeah. So looking at slide 17 here, I just want to elaborate on a couple points which Ashley made. First, people have been referring to the 30% limit against EBITDA. And until 2022, that probably is a pretty good analogy. So, you get to add back depreciation, amortization, depletion, which obviously increases adjusted taxable income and therefore increases the 30% threshold. But after 2022, you've got to continue to deduct those items, or now deduct those items off of ATI. So your 30% limit is going to be, at least for some businesses, more severe. There are also some questions about real property trades or businesses. I mean, first, I think it is clear that a REIT can qualify for the exception, but to qualify for the exception, the holder of the real estate has to elect essentially a longer depreciation period for their depreciable real property. And there was a question about what do you do for an asset which you acquired before 2018, and we don't have any authority yet from the IRS on what to do under these circumstances. But where we think where the IRS is going to go is to essentially allow you to sort of stretch the depreciation period for the adjusted basis or depreciated basis in the asset as of January 1, 2018, and hopefully that's not viewed as a change of accounting method that you'd have to get consent from the IRS. So there is a question about what you do with old real estate, and like I said, there's a hope that you'll sort of have this the stretching out of the remaining basis without IRS consent to qualify for the exception to interest deductibility for a real estate trade or real property trade or business. And Ashley, sorry for interrupting you.
No, thanks for clarifying, Raj. Jumping back to miscellaneous itemized deductions, an investor's share of the expense of a fund and the management fees paid by the fund can still be deductible if the fund is considered to be an active trader of or dealer in securities. The disallowance of the expense deduction is especially problematic for fund managers with respect to the carry, and this is because, as Raj had mentioned, the carry is really a share of both gross income and gross expense, and now gross expenses are likely to be disallowed as a deduction. And again, as Raj had mentioned, fund managers may now wish to take this carry as a performance fee, and something that we've been doing is adding that toggle feature where the fund manager can decide how they actually want to receive their carry income.
Oh, it's my turn. Thank you, Ashley. We're going to take just a quick break, and as it were, it's actually 12:30. So we're halfway through the program to read aloud the CLE code that you guys are going to need if you are seeking continuing legal education credit for this program. So if I could, you should see in front of you a space in which you can put in a 5-digit code. I'm going to read that aloud now. I just need you to type that in and hit the submit button, and we'll be done and we can get back to the program. The code is T as in Thomas, D as in Deborah, T again as in Thomas, 17. Now I'll say that one more time. T as in Thomas, D as in Deborah, T as in Thomas again, 17. Again, if you just put that in and hit the submit button, for those people in Kansas, New York, or New Jersey seeking CLE credit, you'll also need to complete the attorney affirmation form that's there as a PDF in the PDF widget that you should see in your environment. So with that, I will send it back to the program. Thank you.
All right, so I think with that, we're now going to move on to the international provisions. Look, these are very complicated provisions, and we literally could have more than an hour seminar on each of these topics and still probably wouldn't even touch the surface. So in terms of our focus as private equity, we're really just going to touch upon these topics here. So the first I guess new rule is Section 267, Cap A, which prohibits a deduction for any disqualified related party amount paid or accrued in a hybrid transaction. And a disqualified related party amount is any interest or royalty paid or accrued to a related party to the extent that essentially such amount is not included in the income of the recipient, or such a related party is allowed a deduction with respect to the amount under the tax law under the country. So what is new Section 267A getting at? Well, what it's really getting at is the so-called double dip transaction, where for many years, people would use structures where, say, you get an interest deduction in the United States, yet under the foreign tax regime, that income is not includable. Perhaps that interest is treated as a dividend, and dividends aren't taxable in the local jurisdiction, or it's exempt from tax. Whatever the case may be, there were these double dip transactions out there, which Section 267A intends to put an end to. Where do we see this arising in the private equity fund context? Many private equity funds put together leverage blockers in order to block foreign investors from the fund's generation of effectively connected income. For example, this is a common issue which real estate funds have to contend with, as well as direct lending funds, because they are by and large deemed to be engaged in a U.S. trade or business. So what you do is you put in place a U.S. corporation as the investor into the fund, and you have your foreign investors come into that foreign corporation, essentially acquiring both debt and equity of that corporation, and therefore the corporation bears a much lower corporate tax because you're stripping out most of the income from that blocker, of course, now subject to new Section 163J. So in addition to worrying about 163J, also have to ask the question, well, is that interest going to be includable in the income of the recipient under its local tax law? So just another question you have to ask yourself when putting in place a leverage blocker as to whether or not it will continue to be effective under the new tax regime. So moving to the other provisions here, the next few provisions, or a couple provisions we'll be talking about, have really been enacted to discourage U.S. residents from moving assets offshore by creating a penalty tax or regime for moving such assets offshore, and secondly, by reducing the tax imposed on these assets moved offshore. So if you keep that focus in mind, I think it'll give you a better sense of what these next two provisions get at. So what's the first provision? The first provision is the Global Intangible Low Taxed Income, or GILTI. And generally speaking, the GILTI rules are intended to tax the CFC's income that is not Subpart F income or effectively connected income to the extent that the income exceeds a deemed return on the CFC's tangible depreciable property. First of all, what is a CFC? A CFC is a corporation which essentially is at least 50% owned by U.S. persons, where 10% of the vote and value is held by a U.S. person. I'm simplifying it, but generally speaking, that is a CFC, foreign corporation that's mostly owned by U.S. persons, where the U.S. person under consideration here, the taxpayer, owns at least 10% of the voter value of the CFC stock. And so that's where you see the next bullet, a 10% U.S. shareholder. If you're below 10%, you don't have to worry about CFCs. You may have to worry about PFIC, which we won't talk about here, but you don't have to worry about CFCs or the new GILTI regime. And so what does the new GILTI regime do? Well, it takes all of the net income of the CFC and it subtracts from that amount essentially 10% of the aggregate adjusted tax basis of tangible depreciable business property and minus interest expense as sort of an exemption amount, and that excess of that net income minus that 10% threshold is includable as GILTI in the 10% U.S. shareholders' U.S. taxable income. And quite honestly, the GILTI is ill-defined because it does not apply to intangible income. As you can see, it applies to all income of the CFC, but you're sort of entitled to this exemption to the extent that, I guess, you have material tangible assets. So you may realize all services income from your CFC and really have no basis in assets, and that's not intangible income, that's services income, and you still would be subject to inclusion under this new GILTI regime. But there are a couple of, I guess, limitations on this which are quite helpful. Number one is that there is a much lower tax rate on GILTI to the C corporation, which qualifies as a 10% shareholder in the in the CFC. First, until 2025, you can exclude 50% of the GILTI in taxable income, which results in a 10.5% tax on the GILTI, and that is reduced to 37.5% after 2025. So there is a much lower tax rate on GILTI. Furthermore, you get a foreign tax credit that was imposed on the CFC that passes through to the C corporation parent. So by and large, you may not be paying much U.S. tax on GILTI. There is also a other exception that we don't list here, which I do want to mention to you, which is that as long as the U.S. tax rate, or I should say the foreign tax rate, is at least 90% of the U.S. tax rate, GILTI does not apply. So, for example, if the tax rate is 19% or more in the foreign jurisdiction, you don't have to worry about GILTI. If it's less than 19%, you do have to worry about it. And of course, if the U.S. tax rate, corporate tax rate goes up, those thresholds equally go up. So some important exceptions here to think about. Ashley, can you turn it to the next slide? So what are the implications here? Well, sort of they're self-explanatory, but we do want to note that non-corporate taxpayers are really hammered by the GILTI because you now have this substantially higher risk of inclusion of GILTI into your taxable income, and you don't get any foreign tax credit. So what should you do? Well, I think that one should give serious thought to checking the box to treat the CFC as a pass-through for U.S. tax purposes. By and large, most foreign entities can elect to be pass-throughs for U.S. tax purposes. And so if you're talking about either a pre-existing entity or a new entity that you're going to invest in, I would say give serious thought to making the check-the-box election. And number two, think about inserting a blocker corporation, a leveraged blocker corporation, if you will, between the CFC and the foreign investment, or at least a blocker corporation. So, then, of course, there's a much lower corporate tax rate on GILTI that we talked about, the potential for foreign tax credits. And there may or may not be capital gains when you sell that blocker, but you've at least deferred the GILTI substantially, if not reduced the tax as well. So certainly some planning ideas if you hold GILTI directly as an individual, or say through a pass-through like a private investment fund, as opposed to through a corporation. Turning to the next slide, foreign-derived intangible income, or FDII. This is sort of the opposite of GILTI, or at least that's the way that I think about it. And in general, FDII is the deemed intangible income that's attributable to the sale, license, or lease of property to foreign persons outside the U.S. Or the performance of services to persons outside the United States. So, in a nutshell, FDII, and there are a bunch of things we get into the details here on, is the gross income attributable to licenses, leases, other income received from legitimate third parties. So, for example, income from CFCs, related parties, and other exceptions doesn't qualify for as FDII, and you subtract from this 10% of the aggregate adjusted tax basis of U.S. depreciable assets. So you have a deemed inclusion of foreign-based income minus this 10% threshold. Again, it's foreign income, not U.S. income, and that's subject to inclusion in the U.S. person's taxable income. And similar to GILTI, a U.S. corporation is allowed a deduction of FDII for the next 3 years. It's 37.5% through 2025, and then it's reduced to 21.875% after 2025. So you have an effective tax rate of 13.125% until 2026. So again, these two statutes are intended together to dissuade U.S. corporations primarily from offshoring their intangible assets. So turning to the next slide here, which is the BEAT. What is the BEAT? The BEAT is the Base Erosion Anti-Abuse Tax, and it applies really to just very large C corporations. In order to qualify, you have to have gross receipts of at least $500 million for the trailing 3-year period. So again, very, very large corporations. Also, you need to have what's known as a base erosion percentage of at least 3%, and we'll talk about what that means in detail. But that's really a de minimis threshold. And the base erosion percentage is generally the base erosion percentage is essentially the percentage of the tax benefits that you've received from base erosion over all of your deductions. And what are base erosion tax benefits? Essentially, those are deductions taken or other tax benefits realized for payments made or other items with respect to affiliated foreign corporations like CFCs. So the idea is that if you are taking more than 3% of your deductions by making payments to related foreign parties, that you could be subject to this BEAT. And what is the BEAT? Well, the idea is that you're going to have to add back those tax benefits that you've taken, and you need to pay a minimum 10% tax on your now adjusted taxable income, which is called the base erosion minimum tax. So the idea is that if you're over this minimum 3% threshold, if you're a large corporation with at least $500 million of gross receipts, you got to add back these deductions that you took, and figure out if you at least pay 10% on this adjusted taxable income, which goes up to 12.5% after 2025. And there's some different tax rates for banks and registered securities dealers, which we point out on the last bullet of this slide. So anyways, with that, I'll now turn it back to Ashley.
Thanks, Raj. So now we'll go over just a few other odds and ends of new provisions that will potentially impact private equity funds. State and local taxes, while there have been limits placed on what individuals can deduct as far as state and local taxes, those limitations don't apply if they were incurred in a trade or business. And as such, individuals that own a pass-through entity where these expenses were accrued in the process of a trade or business will still be deductible. For U.S. tax exempts, there's a new 1.4% excise tax, which has been referred to as the Ivy League tax, and it's imposed on certain U.S. colleges. And there's also further requirements of the actual size of the endowment of the school and the number of students, but they will be subject to a 1.4% excise tax. UBTI, this is now calculated on a business-by-business basis, so unrelated business losses from one business can be used to offset unrelated business income from another. There's also a transitional rule that allows losses from an unrelated business arising before taxable year 2018 that will carry forward to offset unrelated business income from other unrelated businesses in later taxable years. ECI, this is the repeal of Grecian Magnesite, and now any gain or loss upon the sale of a partnership interest by a foreign investor will be treated as ECI.
Yeah, so just to elaborate on that last point, in 1991, the IRS came out with Revenue Ruling 9132, which essentially took this position that if the partnership is conducting a trade or business, a sale of the partnership interest will similarly be treated as effectively connected income. A very sort of simple ruling, which many people have criticized. Last summer, the tax court agreed with a taxpayer that essentially a sale of a partnership interest does not produce effectively connected income, which, absent regulations or a change in law, most people believed or practitioners believed was the correct answer. So the IRS viewed that this new loophole had been created by Grecian Magnesite, and the new tax law essentially puts that to that I guess exclusion or exemption to rest. So we're sort of back to where we were under 9132, where the sale of a partnership interest it could again be treated as ECI. It's a very simplistic statute because it tracks 9132, and there are a lot of questions about it as to how it apply under certain circumstances. Say where you may have losses passing through the partnership as well, but the general rule is that if the partnership conducts a trade or business in the U.S., the sale of the business or sale of the partnership interest will similarly be ECI as well.
Thanks, Raj. Under the Tax Act, technical terminations are now repealed. So a partnership will no longer be deemed to terminate if 50% or more of the interest are transferred. There's also a special provision for tax accounting, and this is really just special rules for taxable year of inclusion, and it's just a timing difference of when income is recognized.
Yes, and on that last point, there has been a lot of controversy about this new rule. At this point, taxpayers have I guess a lot of difficulty of figuring out when and it won't apply. I mean, the general idea is that if you are taking income into account on your financial statements, the government wants you to take it into account for tax purposes as well. But the circumstances in which that will and won't apply are very uncertain. And in fact, some people believe that this may have created an additional exception as to whether or not you need to include substantial market discount into income or treat as ordinary income when there may have been less certainty before. So some people believe, in fact, this has created perhaps new exceptions to inclusion of income that may not have existed before. So again, a lot of questions on the scope of this last change.
It's not mentioned on the slide, but a lot of questions have come up regarding choice of entity. And now with the corporate tax rate being at 21%, there are some people who are considering structuring their businesses as C corporations because the corporate tax rate is the lowest it's been in decades. And I think it could be beneficial if you don't actually intend to pay out any tax outside of the corporation, and if you're just going to be reinvesting money into the corporation. I think then it actually could be beneficial and a useful tax strategy.
Yes, and just to add to that, if I think the gross assets of the corporation are less than $50 million when you make the investment in the corporation, it has to be an investment. It has to be a primary transaction, not a secondary. Then the sale of that stock can qualify under Section 1202 for a complete exemption from capital gains. Now, in addition to the $50 million threshold, and that it doesn't apply to all trades or businesses, but it applies to most, that there's a 5-year hold. So I completely agree with what Ashley said, that I think a lot more thought needs to be given to whether one should be a pass-through or a corporation because of the reduced tax rate. And in fact, under Section 1202, you can avoid all capital gains. So at least in some circumstances, C corporations could make a lot more sense.
With that, I think that concludes our prepared presentation.
Thank you, Ashley. Again, this is Matt Bradley from Foley. Really appreciate the time there. What I'd love to do, if we do have any questions, there is a widget there at the bottom. If folks have an interest while we have Raj and Ashley on the line, certainly feel free to throw a question in there. We'll take it really quickly here if we can. Otherwise, we'll surrender the time back to everybody to get on with their day. But thank you in advance again to Raj and Ashley for taking the time to present this. A reiteration again for those folks who are looking for the CLE forms, those will be approximately 8 weeks out from today, but you shall receive them. For those folks looking for it in Kansas, New York, and New Jersey, please do remember to grab that affirmation form that the PDF is included inside of the conference here before you leave. We'll need you to put the code that I read aloud into that, and you send that back to my attention, mbradley@foley.com. These slides and everything will be available on foley.com after the fact, so if you'd like to share that, or folks that could benefit from these slides that weren't able to make today's call, certainly encourage you to share that. We'll also be sending around a survey as a post hoc to this event to know how we might be able to make these presentations better, or if there's particular issues you'd like to hear more about as we move forward. I'm sure that Raj and Ashley would be more than happy to provide that sort of content on a go-forward basis. On that note, seeing no questions, I will say thank you again on behalf of Raj and Ashley and everyone at Foley & Lardner for your time, and have a wonderful remainder of your day. Take care.